Something remarkable just happened in the silver market. And if you've been paying any attention to commodities, to inflation data, or even just to your own wallet lately, what's unfolding right now in silver is one of the most important macro stories of 2025 and 2026. Silver just crossed $80 per ounce. Not $30, not $50, $80. And a lot of people are either not paying attention or they're treating this like just another price move in a metal they don't fully understand. But this is not just a price move. This is the beginning of something much bigger. By the end of this video, you're going to understand exactly what's driving it, why it could continue, and what the broader picture actually looks like for everyday investors trying to make sense of this financial environment. My name is John Smith. Welcome back to the channel. We cover finance, economics, and how the big macro forces in the world actually affect your money and your decisions. No fluff, no hype, just clear, honest breakdowns. Today we are diving deep into silver, the Reflation Squeeze framework that explains what's happening right now and why this story is genuinely just getting started. Let's start with context. Silver spent most of the last decade bouncing between roughly $14 and $30. Even during the big run-up in 2020 and 21, when pandemic-era money was flooding into everything, silver peaked around $29 and then pulled back hard. For years, silver was considered the underperforming cousin of gold. People would say, yeah, silver is interesting, but gold is the real store of value, and that narrative stuck. But here we are, $80. And it didn't happen randomly. There's a very specific macro environment that created this moment, and understanding that environment is the entire point of today's video. So what is the Reflation Squeeze? Let me explain this concept, because it's central to everything we're going to talk about. Reflation is a term economists use to describe a period where economic activity and inflation both pick back up after a period of slowdown or contraction. Think of it this way. Imagine the economy is like a balloon. During a tightening cycle, central banks squeeze that balloon by raising interest rates. Inflation cools, growth slows, but when they loosen their grip, the balloon expands again. Money starts flowing, inflation picks back up. And certain assets, particularly hard assets like commodities, tend to move dramatically in that environment. That's reflation. Now the squeeze part is specific to silver. And this is where it gets really interesting. Silver is not just a monetary metal the way gold is. Silver has an enormous industrial demand side. Solar panels, electric vehicles, semiconductors, medical technology, aerospace, and about 100 other applications. Silver is one of the best conductors of electricity on Earth. So when economic activity picks back up globally, industrial demand for silver surges. At the same time, silver's monetary and store value demand also picks up because investors are looking for protection against inflation and currency debasement. You get both forces hitting the market simultaneously, industrial demand and investment demand against a supply side that can't respond quickly. When those forces collide, you get a squeeze. A real, structural squeeze. That's the Reflation Squeeze, and it's exactly what we are living through right now. Let's break down the supply side first, because this is something most people completely overlook. About 70 to 75% of all silver produced in the world comes from mines primarily extracting copper, zinc, lead, or gold, and silver just comes along as a byproduct. What this means is that silver supply is not very responsive to silver prices. When silver's price goes up, miners can't suddenly flood the market with new supply because most of them aren't primarily silver miners. New dedicated silver mines take years to develop, permitting, environmental review, infrastructure. So on the supply side, you have a metal that is relatively inelastic. Supply doesn't change much even when price changes significantly. And that matters enormously when demand starts to surge. Now the industrial demand picture. Over the last 5 years, the world has been going through a massive structural shift in how we generate and use energy. Solar panel installations have been breaking records year after year globally, and every single solar panel requires silver. Silver is used in the photovoltaic cells that convert sunlight into electricity, in the connections, the contacts, the wiring. Some next-generation solar technologies actually use more silver per unit than older designs. On top of solar, you have electric vehicles. The electrical systems in EVs, the charging infrastructure, the power electronics, all of that uses significant silver. Industry estimates suggest that by the mid-2020s, the combined industrial demand from solar, EVs and related green energy technologies could rival or exceed what the entire global silver mining industry produces annually. Think about that for a moment. And when you add in electronics, medical devices, aerospace, and water purification, the picture becomes stark. Here's what this means for the market. For years, this industrial demand growth was being quietly absorbed by existing above-ground silver supplies, stockpiles held by exchanges, refiners, and financial institutions. The silver market ran deficits, meaning demand exceeded mine supply, for several consecutive years. Those deficits drew down those stockpiles steadily. The buffer that existed between industrial demand and mine supply has been shrinking. And when you layer reflation on top of that, when investment demand for silver also picks up, the math just stops working for low prices. Let's talk about the monetary and investment side, because this is the other half of the story. Gold has been leading the charge. Gold crossed $3,000 per ounce earlier in 2025, and that itself was a massive story. Central banks around the world have been buying gold at a pace not seen in decades, driven by de-dollarization pressure, geopolitical fragmentation, concerns about long-term fiscal sustainability, and a desire to hold hard assets that can't be printed. Gold's move above $3,000 was a signal, a big one. Silver tends to lag gold in the early stages of a monetary metals rally. This is well documented historically. Gold moves first, the monetary case gets established. Then silver catches up, and often dramatically overshoots. There's a measure called the gold-silver ratio that tells you how many ounces of silver it takes to buy 1 ounce of gold. For much of the last decade, that ratio was extremely elevated, meaning silver was unusually cheap relative to gold. Historically, the ratio averages somewhere around 40 to 60 to 1. When it gets stretched to 80, 90, even over 100 to 1, that has historically been a signal that silver is deeply undervalued relative to gold. When silver plays catch-up, it tends to do so aggressively. That mean reversion, combined with the industrial demand squeeze, creates the conditions for a major price move, which is exactly what we are seeing. Now, a lot of people look at silver hitting $80, and their first reaction is, did I miss it? Is it too late? I want to address that directly and honestly because it deserves a real answer. Whether you've missed the move depends entirely on your time horizon and your expectations. If you were hoping to buy at $20 and sell at $80, yes, that particular trade is gone. But the deeper question is whether the underlying conditions that drove silver to $80 are over or whether they're just getting established. And that's where the framework matters. Because the reflation squeeze isn't a short-term trade thesis, it's a structural macro thesis. Structural stories don't end in a week or a month. They play out over years. The solar installation boom is not over. If anything, it's accelerating. Government policies in the United States, Europe, and across Asia are pushing enormous amounts of capital into renewable energy infrastructure. That creates structural silver demand that doesn't disappear because the price went up. Industrial buyers need the silver to make their products. They can't just stop buying it. The geopolitical pressure to hold hard assets continues. And most importantly, global central banks are navigating the reality that inflation is stickier and more persistent than many models predicted. The fiscal situation in major economies, the debt levels, the deficit spending creates ongoing pressure on the purchasing power of paper currencies. That's the fundamental backdrop that makes hard assets attractive. And silver, sitting at the intersection of industrial necessity and monetary value, is particularly well positioned in that backdrop. Here's a simple framework for thinking about this. Imagine a three-legged stool. The first leg is industrial demand from the green energy transition and technological applications. The second leg is monetary demand from investors and institutions seeking inflation protection and currency alternatives. The third leg is constrained supply, because silver mining is slow and can't respond quickly to price signals. When all three legs are loaded simultaneously, the stool holds firmly. The reflation squeeze is the condition where all three legs are being loaded at the same time, while the stool itself isn't getting bigger. The price adjusts to clear the market, and that adjustment can be significant and fast. Now, this is a good moment, about halfway through, to say, if you're finding this useful, if you want clear, honest analysis of what's happening in markets and the economy, hit the like button and subscribe to the channel. It helps this content reach more people who are trying to understand this stuff. Okay, back to the story. Let me talk about the broader economic context, because silver doesn't exist in isolation. The Federal Reserve is managing a complex balancing act. Inflation in the United States, while it came down from its 2022 peaks, has proven difficult to get all the way to the 2% target and keep it there. Services inflation in particular has remained elevated. And there are structural reasons: labor market dynamics, housing costs, the ongoing cost of the energy transition itself. When you're building out a new energy grid, you're consuming enormous amounts of raw materials, employing large numbers of people, creating economic activity that raises prices. The transition to cleaner energy creates genuine inflationary pressure in the medium term, and that inflationary pressure supports the case for hard assets like silver. The global picture is also one of gradual reflation. China, the world's largest manufacturer and largest consumer of industrial commodities, went through a difficult period in 2023 and parts of 2024, but stimulus measures have been flowing, and there are signs of stabilization and recovery. China is simultaneously the world's largest solar panel installer, one of the largest EV markets, and a massive consumer of silver in electronics manufacturing. A Chinese industrial recovery, layered on top of the global green energy build-out, is a powerful multiplier for silver demand. Now let me also touch on something most everyday investors don't fully appreciate: the relationship between physical and paper silver. Silver exists in the financial system in two forms. Physical silver is the actual metal. Paper silver is financial instruments, futures contracts, ETFs, and derivatives that track the price. For years, the paper market for silver has been dramatically larger than the physical market. At any given time, the amount of silver committed on paper through financial contracts is many multiples of the physical silver available for actual delivery. When physical demand becomes acute, when industrial buyers actually need real metal, not paper, the dynamics shift quickly. Industrial users can't accept paper delivery. They need the actual material. When there's a scramble for physical silver, the paper price has to reflect that physical reality. That's part of the squeeze mechanism, and it's a dynamic that most retail investors never think about. Now let's talk about risks and counterarguments, because responsible analysis has to include them. The first major risk to the reflation squeeze thesis is a deflationary shock. If the global economy tips into a sharp recession where industrial production collapses and unemployment rises quickly, silver's industrial demand side would take a big hit. In deep recessions, commodity prices often fall sharply even when long-term structural tailwinds exist. Silver is not immune to this. The second risk is a sharp move higher in real interest rates. Silver, like gold, tends to struggle when real interest rates adjusted for inflation rise significantly. Holding silver has an opportunity cost. Silver doesn't pay interest or dividends. If you can get a high real yield from a government bond, the relative attractiveness of holding silver diminishes. In 2022, when the Fed was hiking aggressively, silver and gold both struggled. If that environment returns, it would create headwinds. The third consideration is technological substitution. If a new technology emerged that could replace silver in solar cells or critical electronics, the demand picture would change. Researchers have been working on silver-free solar technologies for years, though so far nothing matches silver's electrical conductivity at comparable cost. This is a long-tail risk rather than an imminent one. And the fourth consideration is simply that silver is a volatile asset. Its price can move 5, 10, even 15% in a matter of days. For investors who can't tolerate that kind of volatility, whether emotionally or financially, that volatility itself is a real risk, independent of long-term direction. These risks deserve to be taken seriously. The framework doesn't mean silver only goes up in a straight line. Understanding the framework means understanding both why the structural case exists and what could derail it. Let me bring in a historical lens, because history doesn't repeat exactly, but it often rhymes. In the 1970s, the United States went through significant inflation, a breakdown in the fixed gold exchange rate system, and an environment where hard assets dramatically outperformed financial assets. Gold went from $35 per ounce to over $800. Silver went from about $1.50 to nearly $50. The structural parallels today: inflationary pressure, fiscal stress, geopolitical uncertainty, a global rethinking of what stores of value look like, those parallels are real. The difference is that silver's industrial demand in the 1970s was nothing like what it is now. The green energy revolution didn't exist. There was no solar panel industry. EVs were science fiction. So if you're looking at the historical analogy, you have to add the industrial demand surge on top of the monetary dynamics. That combination is what makes this particular moment potentially more significant than past silver cycles. Now let me tie this together into a clear mental model you can carry with you as this story continues to develop. The Reflation Squeeze framework rests on three forces operating simultaneously. Force 1 is industrial demand from the global green energy transition. Solar, EVs, power electronics, which creates structural demand growth that is largely price-insensitive in the short run. Industrial buyers need the silver. They can't simply stop purchasing it because the price moved higher. Force 2 is monetary demand from investors and institutions holding silver as a store of value and inflation hedge, driven by the fiscal and monetary dynamics of major economies that create long-term pressure on paper currency purchasing power. Force 3 is constrained supply, because silver mining is slow, capital-intensive, and largely a byproduct of other mining. It can't respond quickly to price signals. When reflation kicks in, all three forces get amplified at the same time. Industrial activity picks up. Inflationary pressure persists. Supply doesn't suddenly expand. The squeeze tightens. The price moves higher to balance the market. That's the reflation squeeze. That's what pushed silver through $80. And that's why the thesis suggests there may be more to come. And here's the thing. Nothing I've just described is financial advice. I'm not telling you to buy silver, sell silver, or do anything specific with your money. What I'm doing is giving you the analytical framework to understand what's happening so you can make your own informed decisions. Whether you're a working professional, a small business owner, someone managing a household budget, the reason this matters to you isn't necessarily that you need to touch silver directly. The reason it matters is that the macro environment driving silver's move is the same environment affecting your mortgage rate, your grocery bill, your purchasing power, the real return on your savings. When you understand the reflation squeeze and what it's signaling, you understand the environment you're operating in financially. And that understanding helps you make better decisions across the board. Quick summary of everything we covered. Silver crossed $80 per ounce, driven by the confluence of industrial demand from the green energy transition, monetary demand from inflation and currency concerns, and structurally constrained supply. The Reflation Squeeze framework describes what happens when economic activity and inflation pick back up after a tightening cycle, putting simultaneous pressure on an already tight silver market. The supply side is inelastic. It doesn't respond quickly to price signals. The industrial demand side is driven by solar, EVs, and technology applications that aren't going away. The monetary demand side is driven by fiscal and monetary dynamics creating long-term pressure on paper currencies. The gold-silver ratio still has room to normalize historically. The risks, deflationary recession, rising real rates, technological substitution, are real and worth tracking. And the broader implication for everyday people is that the macro environment driving silver is the same environment affecting your financial life in multiple ways. This is one of the most important macro stories of 2025 and 2026, not just because silver hit $80, but because of what that price signal tells us about the world we're living in financially. The reflation squeeze is a framework, not a guarantee. Markets are complex and unpredictable, but having a clear framework for understanding what's happening is always better than not having one. If you found this breakdown useful, hit that like button and subscribe to the channel. We're going to keep following this story as it develops. Drop your questions in the comments. I read them. This is John Smith. Thank you for watching, and I'll see you in the next one.